The general rule as to deciding whether you want to do a stock purchase, stock sale, or an asset purchase or an asset sale, the general rule is buyers prefer to buy assets, sellers prefer to sell stock. And that's the general rule both for tax purposes as well as for legal purposes. And again, an attorney can explain better the legal reasons why you might do a stock versus an asset deal. But from a tax perspective, the primary differences are this. A stock transaction, from a seller's point of view, will generally result in capital gain treatment for the entire transaction. That's a very favorable treatment, given the fact that the capital gains rates are much lower than ordinary income rates. With an asset transaction, from a seller's perspective, the transaction will end up, in a worst case, as a C corporation, end up as a double taxed transaction. First, the corporation will pay tax on the sale of all of its assets, and then the individual will pay tax when they liquidate and take all of those dividends or distributions out of the corporation. Hence the traditional term, the double taxation. With even a flow-through entity, such as an S corporation, the sale of stock is still potentially a little more favorable, although not tremendously more favorable, but generally can be a little more favorable because in an asset transaction, there can be some of those assets that are sold that will create ordinary income tax. And that ordinary income tax can cause a slightly higher effective tax bracket than if the seller just sold stock and the entire deal was taxed as a stock transaction and therefore capital gain. Now, from the buyer's point of view, the reason buyers generally prefer assets is that, again, from a tax perspective, they get a step up in basis. In other words, they get to reset the clock on all of the value they paid and get to depreciate that value, which saves them taxes going forward. And of course, buyers want to create as much depreciation as they can. A buyer on a stock transaction doesn't get that step up in basis. They're required to take over the existing assets as the seller held them in their hands, which could be very low, and most importantly, doesn't include the premium or the goodwill value that the buyer most likely just paid for. They don't get to depreciate that, and most of the time buyers just aren't willing to accept that reduction in depreciation. And so what we find is that in most small business transactions, the asset deal rules.